Chris Weston from IG Markets in Melbourne. Chris, there's such an interesting link playing out here, and it really came in the form of yesterday's news on Rio, specifically the Chief Financial Officer, because already in the wake of that Guy Elliott's flagged departure, some are saying this has all the parallels it could well do with the likes of Alan Moss at Macquarie, Richard Utrecht at JB Hi-Fi, a key executive who has picked maybe the top of the market, although it's been falling for some time, and is calling time, and we could well be seeing the price action now start to reflect that. What's your view?
Well, I mean, arguably, he's Guy Elliott's obviously got a great reputation. I think the markets, you remove key personnel and, some confidence does get lost. I mean, it's quite interesting to see some of the other broker recommendations we've seen today. JP Morgan coming out and saying that they still clearly prefer Rio over BHP because of its cheaper valuation, perhaps, getting more return on the investment for different assets at the moment as well. And obviously it's got that larger exposure to iron ore. But I mean, you do remove key personnel. People do like to hold stocks for different management initiatives. But I mean, there is a long handover process as well, which I think is a good situation. Where I think we've got to have all due respect that the board and Tom Albanese can find the right person to replace them. I personally would. If you feel compelled that the global growth story is going to hold up in going into the third quarter and probably going into the back end of the year and into 2013, then clearly Rio is still a very attractive place to be if you've got that longer term horizon on every other metric other than Guy Elliott leaving. So yeah, I think it's a long handover process.
You're totally right, Chris. I suppose just back on your earlier point though, and flagging the JP Morgan support line, one always has to be slightly aware, does one not, when investment banks have done past work for miners. In other words, there's been profit to the exercise. I'm thinking acting for Rio when it comes to Chinalco, for instance. I mean, these are businesses that work together and profit together. So why would they go and diss a customer?
Well, yeah, I mean, if that's the case, I mean, we can push then towards the Credit Suisse note yesterday, where they came off with a similar kind of mantra. They actually downgraded BHP to neutral. They've actually kept Rio overweight because of their like for the iron ore space, the bigger exposure they've got. I mean, I guess you have to look at analyst notes with a hint of salt. I mean, I personally just use them as a guide. It's great to see these guys who have a good knowledge of a company giving a firm understanding and giving their view. But would I trade solely off the back of a broker recommendation or an analyst or a guide? Probably not. I'd like to do my own research and have my own view on the market and the economy and how things are feeding into it. But I think you use them as a rough guide as to how they see the breakdown of the sum of the parts and all those bits and pieces, and you can get a slightly clearer picture. But don't use it solely as a trading opportunity there.
Nice to put into context on that one. Let's just then reflect and give your call on the data drop today. Of all the data, many are now saying actually that look at retail sales. Look at all that effort by Beijing to shift the goalposts to get the domestic growth story really up and running. Is that going to intrigue you today? I mean, and put it this way, what's the dollar most susceptible on which bit of data?
Well, I think it's clearly GDP. I understand what you're saying with retail sales, but I just look at what everyone's been saying. You can watch any channel, any financial channel right now. Every single commentator has put a big emphasis on the GDP number, so it's the one everyone's watching. The retail sales number is important. I mean, the way that they're transferring their mechanism of growth, it's a longer-term story, though, Carson. I think it's a longer-term plan. Retail sales now, we want to see the consumer spending. Of course, we do. That's going to be their mechanism of growth. We talk about consumption increasing. Going forward, I think that makes about 40% of their growth at the moment. It's going to have more of a bearing going forward. China's consumption is actually relatively low on the global stage at the moment. So, yeah, I think the retail sales is a longer-term story. Obviously, we know they're increasing wages in China to try and help that side of things and help put more power and purchasing power in the consumer's hand. But it's a longer-term play. So the emphasis on the market is clearly the GDP number. We have actually seen the Securities Journal in China, which is a state-owned publication, coming out with a headline about 20 minutes ago or so, saying that the number is going to be closer to 7%, which takes it to the bottom end of the range. The range at the moment is 9.3%. I think that's Capital Economics or Access Economics or some firm who are calling 9.3% the top end of the range. That's significantly above consensus. But in the bottom, you've got Citigroup who are calling for 7.3%. So the bottom end of the range, 7.3%. If it comes out at that level, which is what the Securities Journal are publishing, you know, price action post the announcement textbook theory would suggest to me that we are going to get a sell-off in risk assets. The Aussie dollar should come back down towards that parity figure. And like Tom Petrovsky said, perhaps we are going to see that follow through into next week because, you know, China is such a big part of our market. But, you know, there's other things that are at play. I mean, there's been rumours over the last couple of days that we're perhaps going to get another reserve ratio cut, which could happen straight after we get a weak print. And that could then help sentiment going forward.
Well, would it do that, or would it scare the horses even more? Would that reek of desperation?
It would do. I mean, if you look at the mentality of the market at the moment, everything's half empty. I mean, you can just point to the new yuan loans last night. The Chinese new yuan loans came out much higher than expected. Well, they were just higher than expected, but they certainly increased from last month. And then people said, well, let's look at the detail, the devil in the detail in these loans. And the length of the loans, the medium to long-term loans, actually fell as a percentage to about 30% from 34%. So people said, well, look, the quality of the loans that are going out, okay, are actually worse than expected. We want to see long-term loans being provided. They actually fell, but so after the initial bounce, we saw people looking to sell into those numbers. So the market is looking at everything Chinese related as a half-empty scenario. So I think that, you know, if we get a weak number, I think that will feed into this lower global growth story, and I think we'll probably see a continued sell-off rather than some people speculating we're going to get this sell and rumour by the fact type scenario, which could play out with the promise that perhaps we're going to get further stimulus. But you know, they've done two interest rate cuts in a month. They potentially could come out and do another reserve ratio cut. We're going to the third or fourth they've done this year. So yeah, I mean, it's worrying times for the PBOC, and they are getting aggressive because perhaps they have to at the moment.
I was just going to ask you before we lose you. You know, I know you follow the Securities Journal, and of course that's often proved you right in the past. What are you advising clients going up into this data, positioning yourself, stop losses, all the rest of it? What are the suite of options that clients are taking up in preparation for this?
Well, I mean, I think what's interesting is we saw a lot of people over the last 3 or 4 days really shorting some of the high beta names, the mid caps. Fortescue yesterday saw a lot of action on the premise that the global growth story, it's not just China, but the whole global growth story is playing down, and that's feeding it, and they've done quite well. I mean, the trend in the last hour or so has been to close some of those short positions, hence why we've seen a bit of a modest move, I suppose, up. But I think it's about positioning going up until that time. I think we've been surprised before. If we get a good number like Peter Esho was talking about there, you are going to see a massive amount short covering coming through. So it's about protection here. You know, look at some hedges as well. If you are long some of these resource names, perhaps look to go short the Aussie dollar as well, just for a temporary thing. If you've got a portfolio, a physical portfolio, rather than sell out, which you're not going to do just on this announcement, you know, look to hedge yourself, look to short the Aussie dollar against that, and just take a temporary situation. But you know, I think running a position against what really is, to me, is a bit of a lottery. I mean, all the anecdotal evidence we're seeing at the moment suggests a weak number, which could be negative. But if it's good, then you are going to see very, very you know, big short covering, because the market is certainly positioned for a weak number at the moment. So yeah, I think tread carefully around this, because to me it's a bit of a lottery. We just don't know how this number's going to come out.
Right, as much a lottery as maybe the analyst at Morgan Stanley, Mark Goodridge, suggesting, as he has, that Telstra might sell its mobile tower assets, enable it to pay down debt and then assist capital management initiatives. Is that getting any talk around the traps?
Not really. I mean, it might be in some of the long-term plays. It's not something our clients tend to focus on too much with Telstra. You know, they're speculators most of the time. They're short-term traders. So, you know, Telstra's one that they don't tend to get on board too much, to be honest, Carson.
That was the wild card one. We will leave it there. Listen, enjoy the data drop. We'll talk soon.
Thanks.
Thank you.
Australia has come in joint 6th in a ranking of energy efficiency. Australia sharing its ranking with China and the European Union. A report by the American Council for an energy-efficient economy ranked the world's 12 major economies and placed Britain in the top spot. Europe dominates the top